Namaste. I welcome you all to this another webinar hosted by the Accounting Standard Boards of ICI. And now few webinars we would be having in a series, Do You Know series, and which is in relation to the financial statements for the non-corporates and the NPOs. You all are aware that your institute has brought in guidance note for the financial statements for the non-corporates and the NPO and the LLPs. So having a discussion on that, and for that we have got two very eminent panelists. To start with, we have got Dr. Avinash Chandar, who is a very, very well-known personality, not only in India but overseas. Whenever a question comes about accounting standards or India's, he is currently the member of the International Taxonomy Consultative Group of the IFRS Foundation, also the director of the XBRL India, also a regular contributor and invitee to the Accounting Standards Board, Expert Advisory Committee, and other committees of the ICI. He is also the advisor to the government on the GAZAP, also independent consultants to various matters on the Ind AS, IFRS, and others. And of course, those who are in touch with the ICI ASB knows that he has been the technical director and the secretary of the Accounting Standard Board of ICI. I really welcome and thank Avinash Chandar, Dr. Avinash Chandar, for joining and to agree to become a panelist on this very important session. Welcome, sir. Welcome, sir. Along with him, we have got a young and dynamic CA, Dimpy Kandhar. She has not got as good experience as Avinash ji, to be very frank. But when we had this guidance note for the financial statement for the non-corporates and the LLPs, Dimpy has been an avid contributor on this. She has been into this group since the beginning and has always given full contribution on this. And also, if you see that the Excel sheet which is available has all been developed by her. So she has all those ins and outs of this financial statements for the non-corporate formats. So I welcome CA Dimpy Kandhar. Thank you for joining to as a panelist.
Thank you so much, sir.
And to moderate these two, we have got another stalwart, I would say, who's got more than 33 years of experience, who has done certification course on Ind AS and various other, I would talk about courses of the ICIs, including the DISA, forensic accounting, current audit, all he has done. And he is the past chairman of the Ludhiana branch. He has also been a part of this group who has formulated this guidance note on the financial statement for the non-corporates and the LLPs. So a very learned person, moderating these two stalwarts on a very, very important subject. Friends, we all know that if India has to achieve the 5 trillion economy, it is not only the few corporates who have to contribute, but the whole nation has to contribute. And for that, we need to have the financial statements which are standardized. And in that process, the Institute of Chartered Accountants of India, under the Accounting Standard Board, has set up the process to standardize the formats for the non-corporates, that is proprietorship, partnerships, societies, and all others, including the LLPs, through the guidance notes. We'll be having a series of discussion on this to make it aware, because this webinar today, this discussion today, it would be remaining there on the ICAI TV as well as the YouTube channel of the ICI for the years to come. So those who are currently witnessing or those who want to witness it later on or may not be able to join for the full time can always get that link. Our purpose is to have the full awareness of these financial statements, why it is important, how it is important, and how to get it done. So we have broken that into nearly 4 webinars. So the 4 components of the financial statement, basically the assets, liabilities, incomes and expenditures. So today in the first series, we'll be discussing upon the assets. So handing over, if I talk about assets, certain practical issues are there, which would be taken care during this discussion today. Specifically, if we talk about immovable properties, when to take it in the PPE, when to take it into investments, how that has to be classified, disclosed, uh, inventories. So many sides of the assets will be talked about today. Uh, the floor is totally open. Now I hand over this discussion to the moderator of the day, CA Rajesh Kumar Jain from Ludhiana. Please, sir.
Thank you, sir. Thank you. Thank you, Pramodji. At the beginning, I would express my sincere thanks and gratitude to CA Pramod Jain ji for giving this opportunity to be a part of this webinar on financial statements of non-corporate entities and LLPs. As we all know, the ICA, through its Accounting Standard Board, has formulated and issued accounting standards for financial statements of non-corporate entities that prescribes recognition and measurement principles, as well as presentation and disclosure requirements of the events, all the transactions, and the various elements of financial statements. But however, all said and done, in the absence of any standardized formats of the financial statements for non-corporate entities and LLPs for presentation of their financial performance and financial position, different entities over the years have continued to use different formats of presentation which were not comparable, and there was a need to formulate standardized formats for presentation of financial statements of these non-corporate entities and LLPs. ASB has taken this initiative under the chairmanship of CA Pramod Jain ji, along with CA Abhay Chhajar ji, Vice Chairman ASB, and with the continuous support and encouragement of our stalwarts of the profession, CA Aniket Sunil Talati ji, Honorable President of ICI, and CA Ranjit Kumar Agarwal ji, Honorable Vice President of ICI. And they have come up with a guidance note which prescribes the formats of the financial statements for these non-corporate entities and LLPs. These guidance note will guide us how to present the true financial performance and financial position in a standardized format for enhancing the comparability of the financial statements. Both the aforesaid guidance note on presentation of financial statements of LLPs and non-corporate entities had already been issued during the month of August 23. Today we have two eminent speakers to throw light on the one aspect of this guidance note, that is asset side. This webinar will be in the shape of questions. I will throw questions to both the speakers, and I'm 100% sure and confident that they will throw full light on all the aspects of asset side of the financial statements for non-corporate entities and the LLPs. First of all, we'll start with a basic questions which will be taken by Dr. Avinash Chandra ji. Sir, I would say, what was the need to issue a guidance note on the financial statements of non-corporate entities and LLPs? Because there had been these entities over the years. What initiated, what was the reason behind issuing this guidance note? And when this has come into effect, what is the effective date of this guidance notes?
Thank you very much. At the outset, I thank Accounting Standard Board Chairman CA Pramod Jain, who gave me this opportunity to interact with the members and others involved on this important topic. Now, with regard to these two guidance notes which have been issued, primarily, as it has been mentioned, they lay down the formats for the LLPs and the non-corporate entities. And as you very rightly mentioned in the beginning, that currently there has been a diversity of practice with regard to presentation of financial statements insofar as these types of entities are concerned. So the objective, the primary objective, which has also been stated in the guidance note, is to standardize the formats so that the comparability between the different types of entities is facilitated. And another objective would be that these financial statements, since these are used by various users, like for example, the bankers at the time when they give the loans, and by the regulators, like for example, the tax authorities. So therefore, if the formats are standardized, the regulators, the users of the financial statements, they get a uniform type of information. For them to use these types of financial statements is very useful as far as their objectives are concerned. Otherwise, they will, for example, if a banker who is to give a loan, if he finds that there are certain items are not missing, are not there in the financial statements of a non-corporate entity, then he will have to ask the non-corporate entity for the relevant information. Now, if the formats are prescribed, then the formats provide all the necessary information which would be required by most of the users. So therefore, the lenders and the other users, they will have a standardized type of information which they will find, which will facilitate their work also. So that is, to my mind, the objective. And then since the formats also give some kind of guidance, for example, the formats say that these are the current assets. Then the formats also give the guidance as to what are the current assets, how these current assets are defined. And so therefore, appropriate guidance is also given in these guidance notes for the purpose of preparation of the financial statements. And another important thing is that the Institute had earlier stated in the announcements which have been issued by the Council from time to time that the accounting standards are applicable to the non-corporate entities as such. Some announcements have appeared in the Compendium of Accounting Standards, right from 1984, 85 to 1991, that these accounting standards are applicable to these non-corporate entities. Now, this particular guidance note gives an additional guidance in the sense that earlier, while the standards were applicable, the formats was not there. So therefore, there was some kind of a gap as to how to apply the accounting standards in the presentation of the financial statements as such. So so this guidance note is in the context of the accounting standards. So therefore, it bridges a gap, to my mind, that which was earlier there to some extent, that the formats were not existing. So that, to my mind, is the need for these guidance notes. So they will be found useful by the users, that is those who prepare the financial statements, as well as the users of these financial statements. The auditors also, they will find it useful because there will be uniformity in the presentation of financial statements. So the effective date of these two guidance notes is the financial accounting periods beginning on or after 1st April 24. That is 1st April 24. Thereafter, whatever accounts are required to be prepared by the non-corporate entities and LLPs, they should be prepared in accordance with these two guidance notes by following the recommendations which are contained in these two guidance notes. So those financial statements will have to comply with these guidance notes as such. So that, to my mind, I hope I have answered this first question. Thank you.
Sir, Doctor, for this current financial for financially 23-24, it is recommendatory in nature. For
Yeah, 23-24, it is not effective as such. And this guidance note, of course, does not say that whether it can be followed earlier as such. But to my mind, if somebody wants to improve the financial statements, definitely it can be followed. And as far as the status is concerned, since the guidance note, as per the announcements which have been issued by the council, these guidance notes are recommendatory in nature. So even after 24, to my mind, the status of the guidance note will be recommendatory unless some law prescribes it in a particular manner. So the objective is to bring out uniformity in the presentation of the financial statements as such.
Here I would like to pitch in. It is not about recommendatory, mandatory at all, please. One thing is that the technical guide is already there. The technical guide is already there. And if we really want that, we should only practice only on the basis of what is mandatory and what is not. That thought process has to be totally different. We have to see the interest of the whole nation at first, and not merely the compliances. If we want to standardize the financial statements, it cannot be mandatory, recommendatory. One thing has to be followed. It has to be followed. And as regards the applicability of the guidance note, recently Council has already passed it, the authority thereof, which says for the accounting matters, it has to be followed. It has to be followed. And if a person, if an entity is not following those, then they should document the reasons for not following the same and appropriately disclose in the audit report by the auditors. So particularly if I say that is as good as mandatory in nature. So let us not say about that. And we should ensure that whenever an audit is done by a chartered accountant of the financial statements, they should ensure that the financial statements are prepared in this format, because these financial statement formats, if I talk about, ensures at least two things. First, the compliance with the framework of the financial framework for the preparation and presentation of financial statement, which is mandatory in nature. And secondly, compliance of the accounting standards, which is also mandatory in nature. So currently what is being followed in the country is actually overlooking all these things. So if currently what the assessees or the businessmen are doing, they keep on following that, then those compliances would never be there. So these formats are actually helping them to ensure that these are standardized and comparable, not only in India, but world over. So I just wanted to bring that here right now. Thank you. Thank you.
Thank you, Jain sir, for throwing additional light on this subject. Now, CA Dimpiji, what are the entities which are covered under non-corporate entities for the purposes of this standard for guidance note?
Yeah, basically a non-corporate entities means those companies which are not registered under the Companies Act and LLPs registered under the LLP Act. So namely, we can say the sole proprietors, HUF, association of persons, body of individuals, societies which are registered under any law for the time being in force are to be considered as non-corporate entities. So the further guidance note contains an illustrative list of entities, but this is not an exhaustive list or not limited to. So there can be any other form of organization which is primarily engaged in the business or professional activities. Further, the financial needs of the non-corporate entities, we can say that if we look at the financial needs, so as Avinash sir nicely mentioned that there are wide users and stakeholders of the financial information of these non-corporate entities like current and potential investors, lenders and suppliers, etc. So they are mainly similar to how would you find in the case of the other corporate entities.
Dimpidi, apart from body of individuals, the partnership firms are also covered under the
Yeah,
non.
even partnership firm, which are registered or unregistered. Hello.
There seems to be some network issue at Rajesh Jainji.
Yeah,
Rajesh ji, if you can switch off your video and then
कुछ
ask.
network issue है.
राजेश जी अपना वीडियो स्विच ऑफ आप बोलिएगा प्लीज.
Sir, Dr. Sir, please specify what are the audit requirements under the LLP Act and the rules made thereunder, and also what are the audit requirements for the non-corporate entities. Is it audible now?
Yes, audible.
Dr. Avinashi?
Sorry.
Sir, is it audible now, Doctor?
Yeah, now it is audible. Now
Sir,
it is audible. Now it is audible.
Okay. What are the audit requirements under the LLP Act 2008 in the rules made thereunder, and also audit requirements for the non-corporate entities?
Yeah, insofar as the audit requirements are concerned, under the LLP Act 2008, the LLPs are required to be audited in accordance with the rules prescribed. Actually, there are LLP rules 2009. So these are to be audited under those rules. There is, in fact, Rule 24 of LLP rules 2009. However, there is a proviso to that rule that provides that any LLPs whose turnover does not exceed in any financial year 40 lakh rupees or whose contribution does not exceed 25 lakh rupees is not required to get its account audited. So for these smaller LLPs, their accounts are not required to be audited. However, if the partners of such LLPs, they decide to get their accounts audited, I mean the accounts of the LLP audited, then these should be audited in accordance with the requirements of that rule. So, and then, you know, the auditor of the LLP is required to audit the accounts in accordance with the auditing standard issued by the Institute of Chartered Accountants of India and by the Auditing and Assurance Standard Board of the ICAI, and issue the auditor reports in accordance with those standards. Now, in case to an LLP, the tax audit is applicable, then the auditor should issue a report as required under the Income Tax Act also, and Income Tax Rules 1962. In accordance with those rules, the tax audit has to be performed, and for that purpose, the members may take into consideration the guidance note on tax audit under Section 44AB of the Income Tax Act 1961, issued by the ICAI. Now, insofar the non-corporate entities are concerned, if the relevant statute under which the non-corporate entity has been constituted, if that act requires an audit, so that audit will have to be conducted in accordance with the requirements of that act. For example, if some Trusts Act requires some audit to be performed in accordance with the requirement of that act, then those requirements have to be followed. And I mean, in case of the tax audit, the requirements are what I mentioned with regard to the LLP. The same thing is applicable to the NCE and to the non-corporate entities as well. So the audit and for conduct of these audits, these guidance notes would also be helpful because the financial statements have to be audited in accordance, have to be prepared in accordance with these guidance notes. Thank you.
Thank you, sir. MPG, now with respect to this guidance, what are the components of the financial statements of non-corporate entities and NLP? And are there any major differences towards the prevalent financial statements?
So the components of the financial statements for non-corporate entities and LLPs are same as for the corporate entities. So there are no major differences as such. So the major components of the financial statements which makes a complete set are the balance sheet, profit and loss statements, which are also known as income statements, cash flow statement wherever it is applicable. So preparation of cash flow statement is not mandatory for MSME enterprises, that is level 2, 3 and 4 entities. Other part of the FS are the notes and other statements, explanatory material, which are also part of the integral part of the financial statements. So here we can take an example is like such a, as in a partnership firm. So there would be an income and expenditure instead of P&L. So it is just a change in a name terminology, but the fundamentals remains the same of the profit and loss statements.
Dr. Avinashi, DPG talked about this criteria for non-corporate entities. Different set of accounting standards are applicable to different level of entities, non-corporate entities. Please elaborate the criteria for classification of a non-corporate entities into level 1, level 2, and level 3 and level 4. Because
Yeah, sure.
there are certain standards which are not applicable to level 2, level 3, and level 4 entities.
Yes. Yeah, actually, the purpose of this classification is that the smaller entities, they are not put to discomfort because of the onerous requirements, if any, contained in the accounting standards. So therefore, the classification is based on the size of the entities and also whether the entities are listed or not listed. So there are 4 levels which have been, which the guidance note says that the accounting standards are applicable to the 4 levels. Actually, level 1 are considered the large size entities. The large size entities. I will come to what are those large size entities. Then level 2 are primarily the medium size entities. Level 3 are considered the small size entities. And level 4 entities are micro entities. They are the smallest type of entities. So level 1 is the large size entities and the listed entities. So apart from that, level 2, 3, and 4, they are considered as the smaller entities, or they are considered as MSMEs, that is the micro, small, and medium sized entities. So that is how these criteria have been structured as such. Now, as far as level 1 is concerned, all accounting standards issued by the Institute of Chartered Accountants of India, they are applicable to level 1 entities. However, some exemptions with regard to recognition, measurement, and primarily disclosures are given to level 2, 3, and 4 types of entities, which we shall see a little later. And in fact, the Institute in their earlier guidance, they had also classified these types of entities, which were earlier in 2013 some guidance was available. Now this guidance, which we are primarily dealing with, that overrides the earlier guidance. So therefore, the members are advised to read these guidance notes and not the earlier guidance insofar as the classification and applicability of the standards to these entities are concerned. And another thing which I may mention is that this whatever we are discussing is not applicable to those non-corporate entities who may be following Ind AS as per the requirements of any particular statute. Just to give you an example, the real estate investment trusts, even though they are non-corporate entities, or the industrial investment trusts, the REITs and the InvITs which are constituted by the SEBI, although they are non-corporate entities, but under the SEBI regulations, they are required to follow the Ind AS. So insofar as those non-corporate entities are concerned, whatever we are discussing today, these guidance notes are not applicable to these entities. So these are applicable to those entities which fall within the scope of these two guidance notes. Now coming now to the criteria for level 1 entities. First is the criteria of listing is concerned. That is, if there is an entity which is listed or is in the process of listing on any stock exchange in India or outside India, even though it may be a non-corporate entity, then these standards, then it will fall within level 1. The second is that if there are banks, including the commercial banks, or any financial institution, or any insurance business. So if there are non-corporate entities like cooperative banks, etc., to them, they fall under level 1. So irrespective of the size, they fall under level 1. Similarly, listed entities, irrespective of size, they fall under level 1. Then the next criteria is the turnover criteria, which is the size criteria. So for in level 1, those entities which are engaged in commercial, industrial, or business activities and their turnover, and the turnover has been defined as excluding other income. So it is the pure turnover which is realized on the sale of goods or rendering of services, etc., but not other income. If it exceeds 250 crore in its immediately preceding year. So if in the immediately preceding year, the turnover exceeds 250 crore, then it falls in level 1. Then the next criteria is in terms of the borrowings. So if the entity has obtained borrowing, including public deposit, in excess of 50 crore, at any time during the immediately preceding accounting year. So this is very important. It is mentioned at any time during the immediately preceding accounting year. So it is not at the end of the year, it is any time during the year. If it is more than 50 crores, then it is level 1. So it is possible that an entity may have 50 crores, but it has been repaid, and then at the end of the year, there is no borrowing. But still it will be considered as level 1 because during the year, the borrowings were exceeding 50 crores. Then any holding and subsidiary entities of any one of these. So if these entities have any holding or subsidiary entities, then they will also fall under level 1, irrespective of the size of these subsidiaries. In other words, the subsidiary may otherwise fall in the micro criteria on the basis of turnover or let us say the borrowings. But if it is a subsidiary of level 1 entity, then the level 1 requirements will apply to that holding, to that subsidiary as well. Then level 2 entities are those entities. There are basically two criteria once again. In terms of turnover, the turnover exceeds exceeds rupees 50 crore, but does not exceed rupees 250 crore. So if it lies between 50 and 250, then it is level 2 entities. Similarly, borrowings, if they exceed 10 crores, but not in excess of 50 crores, that is, if it is lies between 10 and 50 crores, then it is level 2, and the holding and subsidiary of any of these entities. So level 3 entities are entities whose turnover once again exceeds 10 crores but does not exceed rupees 50 crores. So that is, it lies between 10 and 50 crores, it is level 3. And in terms of borrowings, if it is between 2 crore and 10 crores, then it is the level 3 entity. And of course, holding and subsidiary of any of these entities will fall in this. And level 4 entities are those entities which do not fall within any of the 3 above, then they are level 4 entities. So these are the criteria for classification as far as these entities are concerned.
Dr. Avinash,
Yes,
apart
sir.
from certain exemptions regarding disclosure or presentation of items in the financial statements on certain aspects of accounting standards, there are certain accounting standards which are not at all applicable to level 2, level 3, and level 4 entities. Would you be
Right.
able to throw some light on which are the accounting standards which are not applicable?
Right. So let's look at individual standard wise. Accounting standard 1. Accounting standard 1 is disclosure of accounting policy. It is applicable to all entities, that level 2, 3, and 4. Actually, I'm not talking of level 1 because level 1, as far as level 1 is concerned, all standards are applicable. So I'll be dealing primarily with 2, 3, and 4. Similarly, AS2 is applicable to all level of entities. AS3 cash flow statement is not applicable to either level 2 or 3 or 4. So they are not required to prepare cash flow statements. 4, 5, and 6, and 7, they are applicable to all entities. AS10 is applicable to level 2 entities. Of course, to level 3 and level 4, there are certain exemptions with regard to disclosures. But to level 2, it is fully applicable. There are no exemptions. AS11, that is on foreign exchange, it is applicable to level 2. But 3 and 4, there are certain disclosure exemptions. AS12, government grants, is applicable to all the 3 levels. AS13 is applicable to level 2 and 3. And to level 4, there are certain disclosure exemptions. AS14 is not applicable to level 4, but it is applicable to level 2 and 3. The AS15 is applicable with exemptions to all the 3 types, that is 2, 3, and 4. So the level AS15 has exemption, maximum exemptions in terms of recognition measurement as well. So I may mention with regard to AS15 that I mentioned about the criteria on the basis of turnover, etc., and the borrowings. But insofar as AS15 is concerned, there is another criteria that the number of employees is greater or more than 50. So there are certain requirements in AS15 which are not applicable if the number of employees is less than 50, like, following of the actuarial method, it may not be applicable if the number of employees is less than 50. AS16 borrowing cost is applicable to all level 2, 3, and 4. AS 17 segment reporting is not applicable to 2, 3, and 4. It is not applicable to any of these entities. AS 18 is applicable to only level 2 entities, but it is not applicable to level 3 and 4. AS 19 leases is applicable to all with certain disclosures. AS 20 earning per share is not applicable to any 2 or 3 or 2, 3, and 4. It is not applicable to any of these. Similarly, AS 21 is not applicable. AS 22 deferred taxes, accounting for taxes is applicable to level 2 and 3. However, to level 4, there are certain exemptions which are available. AS 23 is on associates, it's not applicable to 2, 3, and 4. AS 24 is applicable to only level 2 and not applicable to 3 and 4. AS 25 interim is not applicable at all to 2, 3, and 4. AS 26 is applicable to 2 and 3, fully applicable to 2 and 3. However, disclosures exemptions are available to level 4. AS 27 joint ventures is not applicable to any of these levels. AS 28 is applicable to level 2 and 3 with certain disclosure exemptions. However, to level 4, it is not at all applicable. AS 28, if you remember, is an impairment standard. AS 29 is applicable with disclosure exemptions to all the 3 entities, but it is otherwise applicable. So broadly, that is the framework under which the exemptions are available. And because the exemptions, disclosure exemptions and other exemptions are very detailed, one will have to refer to the guidance note as such, because there are paragraphs mentioned which are exempted, so that one will have to look into those requirements. Thank you.
Thank you, Dr. Avinash. We have now looked into the basics and components of the financial statements of non-corporate entities and the accounting standards applicable to different level of non-corporate entities. Now we move on to this guidance note, which have been issued for the financial statement of non-corporate entities and LLPs. CA Dimpiji, please give a brief of general instructions issued for the format of financial statements of non-corporate entities and LLPs in these guidance notes.
Sure, Rajesh sir. For preparation of the balance sheet and profit and loss account of non-corporate entities and LLPs, so one shall use the format which is prescribed under the guidance note which is issued. However, following things are to be taken care while preparing the financial statements. So we'll take one by one. So one has to comply with the requirements of the accounting standards or any statute as applicable to the non-corporate entities, which may require any change in the treatments or disclosures and any modification in the heads or subheads in the format of the financial statements. So here we can take an example of a trust or a cooperative society. So if any format is specified by the law, then they can modify the said illustrative headings and subheadings which are prescribed in the guidance note according to the law applicable to them. Guidance note is prepared using a terminology considering the nature and business of non-corporate entities and LLPs in general. However, certain NCEs may need to amend their certain line items in the financial statement. For example, we can take association of person. So they may need to use a terminology of member funds instead of owner funds. For partnership firm, we have already discussed that they need to disclose use a income and expenditure statement instead of P&L. Further, coming to the disclosure requirements, which are specified under the guidance note, are in addition to and not a substitution to the disclosure as required by any specific accounting standards. So one has to comply the disclosure requirements as specified in the accounting standards issued by ICAI. All the items on the face of the balance sheet and P&L should be cross-referenced to all the related informations into the notes to accounts. All the details which are of important information and for which the disclosure of the same will assist the users of the financial statement shall not be missed out. There should be a balance maintained between providing excessive details. Further, we can see the figures appearing in the financial statement are to be rounded off. So the rounding off will depend upon the turnover of the company. So if the turnover of the company is less than 100 crores, then the rounding off is to be done to the nearest hundreds, thousands, lakhs, or millions decimals thereof. And if the turnover is more than 100 crores, then rounding off is to be done nearest lakhs, millions, or crores or decimals thereof. Once a unit of measurement is used, then it should be we can say uniformly maintained throughout the financial statement. So if the balance sheet is prepared using lakhs format, and then the P&L cannot be into thousands. So there should be consistently maintained throughout the financial statements. Further, the financial statements of the non-corporate entities and LLPs are to be in the comparative format. So one has to give a corresponding amount of the preceding reporting period for all the items which are shown in the financial statement, including the notes. So if it is the first year of incorporation, then the financial statement cannot be prepared on a comparative basis. So these are all the general instructions which one has to taken care of while preparing the financial statements.
Thank you, DP. If we go by Schedule 3 in the Companies Act, it also on the same lines. It contains the general instructions for the preparation and presentation of financial statements of a corporate entity.
Yes.
Thank you, ma'am.
Thank you.
Dr. Avinashi, as regards today's webinar is on the asset side of the financial statements. What criteria must be satisfied for the recognition of an item in the asset?
Yeah. Actually, the criteria for recognition of an item as an asset on the balance sheet, one criteria, of course, in certain standards, the criteria have been laid down. Like in the PPE standard, that is AS10, the criteria have been laid down that when the cost of the asset can be measured and when it is probable that there will be future economic benefits which will arise from the items of PPE, then the asset should be recognized as a property, plant and equipment item on the balance sheet. Similarly, standards on intangible assets and some other standards may give criteria in their, in the standards themselves. So first thing which is to be ensured, of course, I may mention is that first, the particular item should meet the definition of that particular standard. For example, if we are talking of, say, AS10, property, plant and equipment, there is a definition of property, plant and equipment which is given in that standard. First, that definition has to be met. And then secondly, the recognition criteria which are specified in that standard, they have to be met. Similarly, in the other standards like intangible assets also, first you have to meet the requirements of what are considered as intangible assets, and then the recognition criteria like the probability of economic benefit flowing to the entity and the fact that the the cost can be measured reliably. Those recognition criteria are to be followed before these can be recognized as per those requirements which are laid down in the standard. However, it is possible that in some standard, there may not be any criteria which may be specified. So if there are some standard, for example, if for receivables, let us say for trade receivables, there is no standard, for example. no standard lays down the recognition criteria, then one should go to the conceptual framework for preparation and presentation of financial statements. This conceptual framework has been issued by the institute, and that conceptual framework, apart from the definition of the term asset itself, also prescribes the recognition criteria which are similar to those which I have mentioned with regard to PPE. That is the probability of economic benefits flowing from that asset and the cost to be measured reliably. So one has to go to the conceptual framework. In other words, one cannot take the plea that since there is no standard laying down any recognition criteria, I can follow whatever criteria which I want. That is not the case. One will have to go to the conceptual framework and follow the requirements or the recommendations which are contained in the conceptual framework as such. So one will have to be very careful that the definition of an asset should be met and the recognition criteria should be met, and then only one should recognize the assets on its balance sheet. Otherwise, one cannot recognize the assets on its balance sheet. Thank you.
Thank you, sir. It means that apart from this guidance note, which is issued for non-corporate entities, we have to take into consideration and follow the conceptual framework for the preparation and presentation of financial statements.
Yeah, absolutely. Yeah, absolutely right.
That is the basic document which is mandatory since long.
Right. The conceptual framework has been issued long time back, and it lays down, what is an asset in general, liability in general, recognition criteria in general, and things like that, which have to be followed in the absence of any standard laying down any similar criteria.
It also lays down the definition of debtors, creditors, trade receivable, trade payables, and others.
No, debtors, creditors, it defines liabilities, but not debtors, creditors specifically as such.
Thank you, Dr. Manashji. CDPG, now moving into the asset part of the PPE. How the PPE, the property, plant and equipment, is classified in the notes to the financial statement, and how we reconcile the different items of or class of assets of a property, plant and equipment.
Okay, so property, plant and equipment are the major assets on the face of the balance sheet. So classification of PP in the notes to account has to be done nature-wise, like land, buildings, plant and equipments, vehicles, furniture and fixtures, office equipments, etc. So a reconciliation of the gross and net carrying amount of each class of asset at the beginning and at the end of the period has to be disclosed under the balance sheet. So how it is to be disclosed is like there should be a gross block. It will show an opening balance. What are the additions during the year? What is the deduction during the year for the current year as well as for the previous year? And there would be a net block amount. And similar way, there would be an opening balance of the depreciation during the year and the amount, and there would be a net block amount. So similar ways has to be done for each class of the assets. Then further, if there is an asset retired from an active use, that has to be disclosed. If the asset has been acquired through business combination, then that has to be disclosed separately. Impairment losses, if there is an impairment loss in any asset, I guess there is some disturbance.
Just disturbance if there's now it is okay, ma'am.
Yeah, okay. So this all things are to be disclosed. Further, the financial statement shall also disclose for each class of PPEs what are the measurement basis, that is whether the asset has been recognized on cost model or revaluation model, what are the depreciation method used, what is the useful life of the asset, what is the depreciation rate used, the gross carrying amount and the accumulated depreciation at the beginning and at the end of the period has to be disclosed. The financial statement shall also disclose the existence and the amount of restrictions on the title on any PP which are been pledged as security for the liabilities. So these are the disclosure requirements which are necessary. One has to taken care of in the notes to accounts of the financial statements.
Thank you, C. Dimpiji. Now coming into the recognition part of a property, plant and equipment. Dr. Avinash, when several items of property, plant and equipment are purchased for a consolidated price, how the consideration should be apportioned to the various items of property, plant and equipment for presentation in the financial statements and recognition in the books of account.
Yeah, actually, this is a peculiarity, and one will have to go to AS10 on property, plant and equipment to look into the requirements in this regard. Now, generally, as you may be aware, AS10 says that all items of property, plant and equipment, they are to be measured at the cost of acquisition or construction in general. However, if certain items are purchased for a consolidated price, let us say 4 items, like say furniture, fixture, land, some machinery, and some intangible asset. Let's take out intangible asset because we are talking of property, plant and equipment. So let's say some buildings are purchased at a consolidated price. So therefore the question arises how to find out the cost, because the price paid is one, it is a combined price for all the 4 items. So the question arises how to find out the cost of each and every item, because each and every item has not been specified in the agreement as such. So there is a consolidated price which has been paid. So the standard lays down that in this situation, the price which has been paid should be apportioned between those items on the basis of their fair values existing on the date of the acquisition. So in other words, find out the fair values on the date of the acquisition, and then on the basis of the respective fair values of each item, you apportion the price which has been paid, the combined price which has been paid to the seller. Now, what is a fair value? The question then arises what fair value we should take. Then the term fair value has also been defined in the standard, that it is a value. It is a value at which an asset can be exchanged between the knowledgeable willing parties at an arm's length transactions, that is not related parties, at arm's length transaction. The fair value, for example, the market values, if the market values are available, you find out the market values, and on the basis of those fair values, you can apportion the consolidated price amongst these assets which have been purchased. The standard also lays down that in case the fair values, like the market values, are not available in the market, so then what should be done? The standard says that you can appoint a valuer. For example, if the consolidated price is paid for, say, a number of plots of lands, so the amount involved will be very huge. If the market value is not available, then a valuer can be appointed who can then determine the fair values. So in other words, the cost is arrived at on the basis of the fair values of each and individual asset, because that is used to apportion the consolidated price which has been paid to the seller of those assets as such. Thank you.
Thank you, sir. Thank you, Dr. Avinash. Now moving into the next item of financial statement, the leased assets. How CADPG, please elaborate how the asset under lease should be presented in the financial statements of a non-corporate entity and LLPs.
So asset under lease are to be separately specified under each class of assets of PPE. Further, for an recognition of an item under leased PPE shall be disclosed according to AS 19. However, depreciation is to be done as per the accounting standard 10. So we can take an example. If the plant and machinery is taken on lease, then on the face of so under the notes to account, this has to be disclosed separately that this particular plant and machinery is taken on lease.
Now, from the non-current assets, we move into the current assets part of it. Dr. Vinashi, what is the criteria to classify an asset as a current asset? And what is the definition of a current asset?
Yes. Yeah, the definition of a current asset has been laid down in the general instructions for preparation of balance sheet, and it is available in these guidance notes. And this definition is similar to what is there in the case of companies. And the definition is has certain criteria to be fulfilled. So an asset shall be classified as a current when it satisfies any of the following criteria, which I am not going to read. I am not going to read. So any of the criteria, if any of these criteria are met, then the asset will be considered as a current asset. The first criteria is that if the asset is expected to be realized or is intended for sale or consumption in the entity's normal operating cycle. Now here the term operating cycle has been used. So what is an operating cycle? Like, for a manufacturing entity, you purchase raw material. The raw material is converted into work in progress. The work in progress is converted into finished goods. The finished goods is then converted into the debtors if they are sold on credit, and then you realize cash from the debtors. So the operating cycle is the time which is taken to convert cash into cash. That is, cash is first disbursed for the purchase of materials, and then after converting into finished goods, debtors and sale, we again receive the cash. So this cycle may take 1 month, 2 months, 1 year. So depending upon the nature of the activity. So if there is any asset which is expected to be realized during that operating cycle, then it will be a current asset. For example, an inventory, it will form part of the operating cycle because it will be realized or used for sale during that operating cycle itself. So it will be a current asset. Then the second criteria is that if the asset is primarily held for the purpose of being traded, that is, if you are holding some asset only for the purpose of trading, that is, you are buying and selling it, like for example, the plots of land. The land may be considered as a long-term asset. But supposing an entity is keeping land for the purpose of purchase and sale, like for example, a broker is having of the land, or even he may purchase it in his own name. So if they are purchasing and selling as a trading stock, as a stock in trade, then that will also be considered as a current asset. Then the third criteria is that it is expected to be realized within 12 months after the reporting date. So if the asset is expected to be realized within 12 months after the reporting date, for example, if the cash is to be received within 12 months after the reporting date, that is the balance sheet date, then it will be considered as a current asset. And the last condition is that the asset is a cash or cash equivalent unless it is restricted for being exchanged or used to settle a liability for at least 12 months after the reporting date. So any cash or cash equivalent will be considered as a current asset unless this particular condition of the settlement is not satisfied. Now the definition of cash equivalent has not been given here. So for that definition, one will have to go to AS3, which defines cash equivalent. So although, as I have mentioned with regard to the applicability of accounting standard, that the AS3 is not applicable to level 2, 3, and 4 entities. However, even though this standard is not applicable, to find out about the definition of cash equivalent, one will have to refer to that particular standard. So these are primarily the 4 criteria of current assets. So if these criteria, any of these criteria are not met, then such assets are to be classified as non-current. So that's the position with regard to the current assets.
Thank you. Thank you, Dr. Avinashi. Now, CDPG, what are the disclosure requirements related to temporary, idle, fully depreciated, revalued, or retired from active use PPE as required under paragraph 87 of AS10, property, plant and equipment?
So as per para 87 of accounting standard 10, an entity is encouraged to disclose the following things. So for temporarily idle asset, then the carrying amount of such temporarily idle PPE is to be disclosed. For fully depreciated PPE which are still in use, then the gross carrying amount of such asset is to be disclosed in the financial statements. If the asset has been revalued, for each revalued class of PPE, the carrying amount that would have been recognized had the asset been carried out under the cost model is to be disclosed. And the last one is the assets which are retired from an active use and not held for disposal, then the carrying amount of such asset is to be disclosed. This is what AS para 87 of the accounting standard 10 is encouraging to disclose.
These retired from active use assets are to be disclosed at the written down value?
Retire use of from the active use.
These assets which have been retired from active use are to be disclosed at the written down value.
The carrying amount.
The carrying amount. Okay.
Yeah.
Actually, it is carrying amount or net realizable value.
Whichever is less, I think. Carrying amount or the net realizable value as on the date on which it has been classified as held for sale or retired from active use. On that date, the carrying amount or the net realizable value of the asset has to be disclosed, whichever is less. Thank you, DPG.
Thank you.
Dr. Avinashi, we have talked about the tangible asset, the property, plant and equipment. In fact, how the intangible assets are classified in the notes to the financial statements, and what is the reconciliation statement which is to be prepared in respect of each class of intangible asset?
Yeah. Now, intangible assets, while the property, plant and equipment will be very common to all types of entities, but these intangible assets may not exist for many of these entities of which we are talking about. However, to the large entities, these intangible assets may appear significantly, but even to level 2 and level 3 and sometimes to level 4 entities, there could be some, let's say, computer software, because computers are very common these days. So somebody might have purchased, say, tele software. So the computer software that will appear as an intangible asset in the balance sheet. Similarly, some common intangible assets for even smaller entities could be the licenses which it might have obtained, to operate its business. So supposing it is a small fishing company, So if there is a fishing license which has been obtained, so that license will be considered as an intangible asset. And similarly, there may be smaller entities who are operating as a franchises of the larger entities. So these franchises once again, if you have paid something to run as a franchise of some other entity, then this franchise, under franchise agreement, you have to pay certain amount. So that amount is considered as an intangible asset. So it will have to be disclosed. So in the formats, so therefore, the classification has been prescribed in the formats like goodwill, brands, software, mastheads, mining rights. Of course, mining rights, one may argue that for these smaller entities may not exist. But however, there can be some entities like, limestone quarrying. Some smaller entities may be carrying out this limestone quarrying. So those, to them, if they have paid for obtaining any mining right to, let us say, some government, then that will be an intangible asset for that company. Similarly, the copyrights, if they have paid for copyrights or they have obtained some patents, then these are considered as intangible assets. So these are classified separately. So any design, models, recipes, so there can be different types of intangible assets. So they have to be specified classified separately and disclosed separately in the notes to the financial statements. Now, with regard to the reconciliation means the movement of the assets, movements of the amounts of the assets. What I mean by movement is that what was the opening balance of the asset at the beginning of the year and what is the closing balance of the asset at the end of the year. So during the year, many changes could have taken place. For example, on account of, say, more additions, more intangible assets might have been acquired under that category. So those additions have to be separately shown. If there are any disposals, they have to be separately shown. If any acquisitions have been made through amalgamations, etc., they are also required to be separately disclosed. If there is any amortization is like depreciation because these intangible assets are to be amortized. So that amortization is also to be shown separately so that at the end of the year, after making all these adjustments, you get the closing balance. So apart from this, if there is any impairment of these intangible assets, that also is a change in the impairment asset that is also to be shown. So after making these adjustments in the opening balance, you reach it at the closing balance. So that reconciles the opening balance with the closing balance. So that all those things have to be shown, disclosed separately. Thank you.
Thank you, Dr. Avinashi. Investments are always the most important part of a financial statement. CADPD, please throw light on how the non-current investments are classified in the notes. What are other details that may be given in respect of each classification of non-current assets?
So non-current investments shall be classified as trade investments, which are both quoted and unquoted investments. So quoted investment means an investment in respect of which there has been granted a quotation or a permission to deal on a recognized stock exchange. And the other investment which are further classified as investment in properties, investment in preference shares, investment in debentures, mutual funds, government securities or trust securities, equity instruments, etc. So under each classification, details are to be given, like name of the entities in whom the investment has been made, whether it is partly or fully. In regard to the investment is a partnership firm, the name of the firms, including the name of the partners, what are the capital invested, and the shares of each partner is to be disclosed separately into the notes to accounts. Further, in investments, following things are also to be taken care of. So if the investment has been carried other than the cost, then this has to be separately stated and specify what are the basis of the valuation. Further we can say the aggregate amount of the quoted investment, unquoted investments are to be disclosed. If there is any diminution in the value of investments and there is a provision thereof, then that also has to be disclosed separately.
Thank you. Thank you, ma'am.
Yes.
Dr. Avinashi, we are on the subject of investment. Under what circumstances the diminution in value of an investment should be provided for? Both for the current
Yeah.
investments and the non-current investments.
Yeah, actually, for the purpose of the finding out the circumstances, one will have to go to AS 13, accounting for investments. And AS 13 classifies the investments into short-term and long-term investments. And the short-term investments are generally less than 12 months, and long-term investments are more than 12 months, which are held for more than 12 months. So the diminution, while the current investments or the short-term investments, the current investments under AS 13 are valued at the lower of cost and fair value. The long-term investments are valued at cost. However, it has been laid down that if there is other than temporary decline in the value of investments, then that should be provided for. Now here the problem arises with the usage of this term. What is other than temporary? Now some people consider that other than temporary is the same thing as permanent. So it is argued that if there is a permanent decline in the value of investment, then only I will make a provision for that investment. I mean, that fall in the diminution in the value of long-term investment. Otherwise, if it is not, otherwise I will not make that provision. Now, I may mention that the standard has intentionally not used the term permanent. Otherwise, standard could have used the term permanent fall in the value of investment or permanent decline in the value of investment. The standard has used the term other than temporary. So what is the meaning of other than temporary? The meaning of other than temporary is, first let me mention that what is permanent. Actually, in the world, nothing is permanent. So everything is subject to some change. So therefore, other than temporary is that it is, if a fall in the value of investment is not temporary, then you should make a provision. But if you consider that it is temporary, then you should not make a provision in the diminution in the value of the investment. So what is temporary then? Then the question arises that what the temporary is, that because of the seasonal nature or because of certain special circumstances, certain changes have occurred in the value of the investment, then you don't make a provision. But if you consider that these changes are not temporary, and they are likely to continue in future also, then you should make a provision for the diminution in the value of investment. And for the purpose of determining the value of the investment, one can look at the market value of these investments, on the basis of which one can reach a conclusion. However, I may here add that it is a very practical, in practice, it is considered as a very ticklish issue as to what is considered as an other than temporary. And many times, it is basically left to the judgment of the management of the entity and the auditor as to what is considered as other than temporary. So therefore, in the absence of any, you can say, any bright guidelines or any, you can say, very specific guidelines, it is a matter of judgment. For example, it could have been stated that if there is more than 10% fall in the value, then you make a provision. So nothing of that sort has been mentioned in the standard. So here you have to make a judgment. What is not temporary, what is other than temporary. And if you consider it is other than temporary, then only you make a provision for the fall in the value of investment. In other words, these long-term investments are impaired only in these specific circumstances. Thank you.
Thank you, Dr. Vinashji. C. Dimpini, how sometimes there are unpaid calls in respect of investment in equity instruments. How these unpaid calls should be disclosed in the financial statements?
So investment in equity instruments are a part of a non-current investments. So if there is any unpaid calls or calls in arrears in regard to such investments in equity, then same shall be deducted from the gross value of investments.
It should be, that means whatever the call paid amount is to be shown in the financial statements.
Yeah, so see, for example, if the investment is of 1 lakh and there is a call arrears of 1,000 or 10,000 rupees, so that has to be deducted from the amount of 1 lakh and the net has to be disclosed.
Okay.
Yeah.
I think with the unpaid amount is also to be shown as a contingent liability or commitment. Commitment it is to be shown.
Yes, yes.
Dr. Vinashji, I am right?
Yeah, it is to be shown as a footnote.
As a commitment.
It should be. Yeah, it should be shown as a footnote.
Dr. Vinashji, as regards the financial statement, what is the classification for the long-term loans and advances?
Yeah. Let me first explain the term long-term. Now, what the term used in the formats which are given in these guidance note is long-term loans and advances, and these are shown under non-current. So we have seen the definition of current and non-current, that what is not current is non-current. So what is long-term and short-term, that has not been defined in the neither in the guidance note nor anywhere in the standards. So the question therefore arises, what should we consider as long-term loans and advances? So my suggestion would be that loans and advances which do not fall as current loans and advances, that is those loans and advances which do not meet the definition of current assets, they should be considered as non-current loans and advances, and they should be considered as long-term loans and advances. So under long-term loan and advances, the guidance note which prescribes the format, it says that it should be first classified into 3 categories. One, A, capital advances. Now, what are the capital advances? Capital advances are those advances which have been made towards acquisition of, let us say, some asset. So if some asset is to be constructed and some advances have been made, I mean, let us say some building is being constructed and you have made some capital advances, then those capital advances are to be recognized here. Then the second is the loans and advances to related parties, and it is mentioned giving details thereof. Now, what are related parties? One will have to go to the standard AS 18 as to what are the related parties. So loans and advances, if they have been given to related parties, let us say to partners or to directors or some such, some companies which are subsidiaries or entities which are subsidiary to these entities, then they are required to be disclosed under this category. However, another question arises. I may mention that when we were discussing, that the applicability of standard, I mentioned that AS 18 is applicable to level 1 in any case. It also is applicable to level 2. However, to level 3 and 4, the standard of related parties is not applicable. Then the question arises that in the formats, it is mentioned that you have to disclose loan and advances to related parties. Now, if supposing there is an entity which falls in level 2 or level 3 and 4, whether they have to give these details because the standard defines the related parties, and this guidance note prescribes in the formats that any loans and advances to the related parties are to be disclosed separately. However, the standard does not apply to level 3 and 4 entities. Now, what these level 3 and 4 entities have to do in that case? Now, as Dimpy ji just now read just a while ago, that these in the general instructions, it has been laid down that the standards will override these formats. Similarly, the standards as applicable to these entities, they would override the formats. So in other words, if to level 3 and level 4, the AS 18 is not applicable, then to my mind that even though this format prescribes loans and advances to related parties to be disclosed separately, they may not disclose these details because the standard itself is not mandatory, is not applicable to level 3 and 4 as read with that announcement which Dimpy ji just now read, that the standard overrides the formats. And the last category is other loans and advances. For that, you have to specify their nature. Now, apart from this, the loans and advances, they have to be classified between secured, considered good, unsecured, considered good, and doubtful. So like they have to be separately, for example, if the loan is given to, say, partners, or a loan is given to directors. Now, whether it is secured, it is unsecured. If it is secured, it is to be shown separately, unsecured to be shown separately, and if it is doubtful, to be shown separately. And then the format lays down that if there is any allowance for bad and doubtful loans and advances, that is, if a provision is made for doubtful loans and advances, it has to be shown separately. That is, the gross loans and advances are to be shown, less the provision or the allowance for bad and doubtful debts, and then the net amount of loans and advances are to be shown. So that is the requirement of the long-term loans and advances insofar as these formats are concerned. Thank you.
Thank you, Dr. Avinash. CA Dimpy ji, what are the items which are covered under the other non-current assets? And in other non-current assets, bank deposits with more than 12 months maturity. What it means, whether it is 12 months from the reporting date or the original date of maturity.
Okay, so as Avinash sir rightly said, that the non-current asset means the assets which are held or realizable for more than 12 months. So the other current assets shall be classified as the security deposits, bank deposits with more than 12 months maturity. So first we will see that what are the security deposits. So we can take an example over here that if the company has let out any premises on rent and the company has received any amount as security deposits, then these are to be disclosed under non-current asset. That is, the period is so the period is more than 12 months as on the reporting period is to be considered. So coming to the next part, which you said that the other non-current assets includes bank deposits with more than 12 months maturity, and it should mean that 12-month maturity from the reporting date. So yes, so bank deposit with more than 12 months maturity are to be considered from the reporting period. That is, the maturity should be constructed as remaining maturity of more than 12 months. So for example, if as on 31st March, if the maturity of deposit is more than 12 months, then it is to be shown as other non-current asset. Otherwise, it is to be shown under other current assets.
Thank you, C. Dimpy. Dr. Avinash, C. Dimpy has already talked about the non-current investments. As regards current investment, how these current investments are to be classified in the notes, and what are the other details which is to be given in respect of current assets? And I'm specifically talking about investment in partnership firms. How these investment in partnership firms is to be disclosed in the financial statements of a non-corporate entity.
Yeah. Actually, the first, the current investments are to be classified on the basis of their nature of the investment. For example, investments in equity shares, preference shares, government and trust securities, debentures or bond, mutual funds, partnership firms, they are to be disclosed separately. That each and every classification, like equity, should be separately disclosed, preference shares should be separately disclosed, mutual funds investment should be separately disclosed. Now, the details, some details are also required to be given that under the formats which have been mentioned in these guidance notes, that under each classification, details shall be given of names of the entities, indicating separately whether such entities are joint ventures or controlled specific purpose entities in whom the investments have been made, right? So that you have to give the names of those entities also, that in which you have, for example, if you have equity investments in, say, Hindustan Unilever or say TCS, then the names have to be mentioned separately. They have to be given. They have also to be given separately. And also it has to be specified where applicable, that if the investments are made in, say, some joint venture, then it has to be specified that whether that investment is, that company is a joint venture or not, or is a some controlled entity. If you control some entity, it may not be a joint venture, but if you control some entity, special purpose entity which you control, that has to be specified separately. And also, apart from that, if these investments are partly paid, they have also to be specified. Like these equity instruments, if the calls have not been fully paid, they are partly paid, then that has also to be specified. Now, with regard to the investments in partnership firms, what is required to be disclosed separately is that the investments in the capital of partnership firms, for that partnership firm, the names of the firms will have to be disclosed, along with the names of their partners, total capital, and the share of each partner shall also be given. Now, they are very onerous disclosures which have to be made, that you have to show the names of their partners, their share in the total capital of their total capital, even the total capital in that partnership firm has also to be disclosed. So that these types of disclosures are quite onerous. So one will have to do it very carefully so that nothing is omitted as that becomes a non-compliance with the requirements of these guidance notes. And apart from that, the basis of valuation of individual investments will also have to be given. That is, whether these are measured at cost or at some other amount, say fair value wherever applicable. Then the aggregate amount of quoted investments and market value thereof, that has also to be disclosed. Then aggregate amount of unquoted investments, that if an entity has invested in unquoted investments, then what is the aggregate amount of those unquoted investments? And finally, the aggregate provision made for diminution in value of the investments, as we discussed earlier, that has also to be disclosed separately. So with regard to these, these has to be shown. I mean, in case of current investments, if there is a fall in the fair value, that has to be shown separately that there is a fall in the fair value. So these disclosures are quite detailed disclosures which are required to be made, and it is to be ensured that nothing is to be left out. Thank you.
Thank you. Dr. Avinash, investment in partnership firms, there may be cases that these investment in partnership has to be shown in both the current investments and non-current investment, because fixed capital amount has to be shown as non-current investment and the current capital is to be shown as the current investments. CADPD, now, how are the inventories classified in the notes to the financial statements?
Okay, so inventory are the part of the current assets. As per accounting standard 2, inventories are assets which are held for sale in the ordinary course of business or in the process of production for such sale, or in the form of materials or supply to be consumed in the production process or in the rendering of services. So it is a definition which is according to the AS2, and inventory should be valued at the lower of cost or NRV. And as per AS2, the cost, the definition of the cost says that the cost of inventory shall comprise of cost of purchase, cost of conversion, and other cost which has been incurred in bringing the inventory to its present location and condition. So inventories are to be classified as like what are the raw materials, finished goods, work in progress, what are the stores and spares, stock in trade. Stock in trade is to be disclosed in respects of goods which are acquired for trading. Loose tools, like goods in transit, shall also be disclosed under the relevant subheads of the inventories.
Okay. Thank you, DPD.
Yeah.
Dr. Avinash, what is the criteria to recognize stores and spares as in inventories or an item of property, plant and equipment?
Yeah, actually, we will have to go to the AS10 property, plant and equipment, which deals with the classification of spares and standby equipment. The term stores is not used in that standard. So the stores will generally be considered as inventories. However, the spares and the standby equipment. So the AS10 says that if in respect of spares, etc., if they meet the definition of property, plant and equipment as laid down in AS10, that is the definition is that these are held for use in production or supply of services, supply of goods or services, or are for rental for others, or for administrative purposes. That is the one criteria for the definition of PPE. And the second criteria is that they are expected to be used for more than 12 months period. So if the life is more than 12 months, and if the first criteria is that if they are to be used in the production or supply of goods, then these should be classified as property, plant and equipment. But if the life is, say, less than 12 months, for example, in case of some consumable stores or some spares like nuts and bolts, etc., the life may be less than 12 months. So in those cases, they are to be considered as inventories. So that is how the classification will have to be made. Right.
Thank you, Avinash. CADPD, how the goods in transit in the report, as on the reporting date, should be presented in the financial statements?
So goods in transit refers to the inventory items and other products that have been shipped by a seller, but they have not yet reached to the purchaser. So when a goods are in transit at the end of the reporting period, they require special accounting attention, since the goods are not physically present either at the seller's or at the buyer's location. So it is necessary to examine whether the sales terms were on FOB shipping point or FOB destination. So the rules are here to be followed is that if the terms are on FOB shipping points, then the goods in transit are the property of the buyer. So means the risk and rewards has been transferred. And if the terms are on FOB destination, then the goods in transit are the property of the seller. So we can take a here a small example. So let's assume that both the company, that is a seller, and the customer, who is a buyer, have a reporting period with the year end of 31st of December. And the company has shipped a truck loaded of merchandise on 30th of December to a customer who is located 3,000 miles away. So the merchandise arrives at the customer's location on January 2. So between December 30th and January 2, the merchandise is an example of a goods in transit. So if the term is on the FOB shipping point, the company will record a sales and a receivable as on 30th of December and will not include the same as goods in transit as on 31st March inventory. And on 31st December, the customer who is the owner of the goods in transit will need to report a purchase, and a payable must include the goods in transit in his inventory. If the terms of sales are on FOB destination, the company is a seller will have to have will not have a sale and receivables until January 2. This means this company has to include it as a means the company has to include the cost in goods in transit as an inventory as on 31st of December.
Thank you, CDPD. Now
Yes.
moving into one of the most important part of financial statement, Dr. Vinarji, how are the trade receivables classified in the notes to the financial statements, and how the due date for receipt of a trade receivable should be determined?
Yeah. Actually, the first thing to be considered is that what are trade receivables, because there can be different types of receivables. So the question arises first, what are trade receivables? So that definition of trade receivables has also been given in the format that these are the receivables which arise on account of the the goods sold or services rendered in the normal course of business. So only those should be considered as the trade receivables. And with regard to the classification is like the receivables which are secured and considered good, they should be separately classified. Those which are unsecured but considered good, they should also be separately classified. And the third category are those which are the doubtful receivables. Those should be classified separately. And any allowance, like in case of loans and advances, which I mentioned earlier, any allowance for bad and doubtful debts should also be disclosed separately, so that you first know what are the gross advances and gross receivables and what are the net receivables. Now, with regard to the due date, the standard requires, not standard, the formats require that the amount of trade receivables outstanding, the language is very important, so therefore I am reading it out from the formats themselves, that the aggregate amount of trade receivables outstanding for a period exceeding 6 months from the date they are due for receipt shall be stated separately. So the 6 months from the day they are due for receipt. So for example, you have sold goods for credit, right? And let us say the credit period is 3 months. So the credit period is 3 months. So then the question arises, here it is mentioned the due date is after 3 months. Let us say after 3 months they fall due on, say, 1st of June. So then after 1st of June, further 6 months. So for a period exceeding 6 months from the date from which they fall due for receipt shall be shown separately. So after 1st June, that credit period is available, and thereafter further 6 months, that means total 9 months. If within those 9 months any receivable has not been paid by the customer, then for those receivables, separate disclosure will have to be made in aggregate amount. That is the requirement in the formats. Thank you.
Thank you, Dr. Avinash. There are certain questions in the chat box. We should take these questions first, and then we'll move on to balance of the questions on assets if the time permits.
Okay.
I throw these questions to both the panelists. The guidelines require that the fixed assets, that means now it is called property, plant and equipments, are required to be shown at gross value and not the written down value. But for old companies which are 50 years old, how to resolve this issue? This is very common to all the non-corporate entities because they present their financial statement on written down value method. And since there are certain entities which are very, very old non-corporate entities, how to resolve the issue of gross value of fixed asset and gross value of property, plant and equipment, and the depreciation up to the date of the financial statements?
Yeah, I understand this problem. Actually, this issue is also quite common even in government entities also, where they start following, for example, the accrual method of accounting for the first time. So then the question arises as to how to find out the gross amount as such. So normally of course, nothing has been laid down as such in the guidance note as such. So whatever I am speaking from my own, you can say, my own information which is available to me. That, first thing is that it is suggested that if you can try to find out the original cost of those assets as far as possible. For example, it is possible some records may be available within the entity which you may be able to get hold of. So if you can find out the cost of those assets, then find out the cost, on the basis of that one can work out the depreciation, etc., the earlier depreciation, and come at the written down value as such. Then if these records are not available, then the question arises what to do, which could be a situation. So in that case, the one suggestion which is generally given is that you find out from the market the replacement costs of such assets, similar assets, and then try to find out the gross values on that basis. So if that is also not practicable to find out, then many times it is suggested that on the date on which you start applying the guidance note or the whatever method you have doing it for the first time, whatever are the written down value on that date, you presume that they are the gross carrying amounts, and then you start following the depreciation thereafter and make the disclosures as per the requirements of these these two guidance notes. So that would be my from my exposure to other entities, that is generally what is done. However, if Dimpiji wants to add something, most welcome.
No, sir, I agree with your views, what you have discussed.
Thank you.
Actually, I want to add something. Because in these kind of non-corporate entities, there was no requirement to even to maintain the fixed asset register, the register for disclosing the cost or the location of the asset, as is in the case of a corporate entity. So they have to go by this method which you have told, that if it is practicable to arrive at the gross value, try to arrive at. If it is not practicable at all to arrive at the gross value of asset, then the written down value as on the date should be considered as the original cost of the asset, and from this date onward they should continue to follow this guidance note on the presentation of the property, plant and equipment. Is this the conclusion as on date, sir?
Yeah, that is what I said. But as far as possible, the gross amount should be tried to be ascertained. Yeah.
And the next question goes to, what should be the rates of depreciation to be provided in the books of accounts of an LLP?
So the rates of depreciation to be provided is it is to be as per Schedule 2, which we used for the corporate entities.
Schedule. It is for AS10 should be used, because
Yeah, AS10 should be used, but Schedule 2 also specify the rates, right?
it specifies only the useful life on asset on the basis of which we arrive at the rate.
Yeah.
Useful Schedule 2 to the Companies Act only specified a useful life on asset on the basis of which we arrive at the depreciation amount or the depreciation rate. I think, Dr. Would you elaborate on it? That because AS10 is the guiding force, since Schedule 2 to the Companies Act is not applicable in case of non-corporate entities, then AS10 should be the guiding force.
Right. I agree with you. Actually, the AS10 prescribes the principles on the basis of which the depreciation should be worked out. And the principles of AS10 are there to first estimate the useful life of the asset, and then on the basis of the estimate of the useful life of the asset, there are certain other principles which have been mentioned. So you find out what is the more appropriate rate of depreciation. Now, as Dimpy ji has mentioned, and you have also mentioned, that the Schedule 2 lives of the assets which have been given for the companies, while they are not directly applicable to the non-corporate entities, because they are not non-corporate entities, so one cannot force them to follow those particular rates, but these can be used as a kind of a guidance, that these rates can be used as a kind of a guidance. And I may, I may also mention that in some cases, the non-corporate entities try to follow the income tax rates. So I would suggest that those income tax rates should not be followed, because many times those rates are not consistent with the requirements of AS10, because they are sometimes based on giving incentives to the assessees rather than truly reflective of the useful life of the assets. So the income tax rates should be avoided to be followed, although I understand that in many cases the entities try to follow the income tax rates. So they should not be followed. Try to find out the useful life based on the requirements of AS10, and for guidance, use Schedule 2. Thank you.
Useful life of the asset, residual value of the asset, these should be worked out on the basis of AS10, and for that useful life we can use Schedule 2 as a guidance.
Right.
And the next question goes, whether disclosure of aging of receivables and payables are also need to be disclosed in the financials of LLPs and other non-corporate entities.
I could not follow aging of aging schedule of
receivable and payables also need to be disclosed in the financials of LLPs and other non-corporate entities.
No, I mentioned just now about trade receivables, that the trade receivables outstanding for a period exceeding 6 months are to be required to be disclosed. So that is the disclosure with regard to the aging that is required to be disclosed. There are no other disclosures to my mind insofar
Trade
as
payables, for trade payables, there is no aging requirement to be disclosed in the financial statements of a non-corporate entity.
yeah,
Only the aging schedule is with respect to trade
receivables.
receivable, and that two classifications.
Yeah, two
Option is for
classifications.
a period exceeding 6 months from the date they are due for receipt, and for a period less than 6 months from the date they are due for receipt. And the final question goes that please suggest if any amount become due to rounding of how to disclose these items. I am unable to understand this question. Please suggest if any amount become due to rounding off.
Due because of rounding off.
I think sometimes there is a difference of 0.01 or 0.02. I think this could be the question, that sometimes we round off the figures. There becomes a difference of 0.01 or 0.02 in the balance sheet.
Actually, these are immaterial amounts generally, rounding
These
off,
are to be
because rounding off is for immaterial amount. So it's not, if it is material, then only the problem arises. For immaterial amounts, there is no issue involved to my mind. So these can be adjusted in any of the items.
Definitely.
The amounts are not material.
Then final question is, please define the reporting date.
The reporting date is the date on which the balance sheet and the profit and loss accounts are prepared. That is the reporting date. And generally, in India, the reporting date is the 31st March of every year. And for companies, for example, the law itself lays down 31st March. And for non-corporate entities, because the accounts are also prepared for income tax purposes, etc., the 31st March is considered to be the reporting date. So that is the reporting date for the annual financial statements. But if you are preparing, say, interim financial statements, I mean, if some non-corporate entities generally may not be preparing, but in any case, supposing bank is asking you to prepare, say, balance sheet for 3 months, then the reporting date will be the end of that 3 months. So the reporting date is the date for which the financial statements are prepared. So it may, normally it is 31st March for all, for annual financial statements generally, but it could be different depending upon the requirements under, I mean, by the law or by the bankers or in specific cases.
Then the final question is, please explain the role of trade cycle. It's not trade cycle, it is operating cycle.
Operating cycle, yes.
Yes, the question is, please explain the role of trade cycle. It is operating cycle.
Yeah, operating cycle, I explained that it is movement, it is how the cash changes its forms. From cash, you purchase material, then there is a raw material inventory, then you start manufacturing the good, it becomes a work in progress, then the work in progress becomes finished goods, and the finished goods are sold, and then you can have debtors, and from debtors you again get cash. So from cash to cash, there is a certain time which passes. I mean, sometimes is depending upon the nature of activity. For example, for some manufacturing entity, this time may be very less, say even 1 day. For some entities, it could be 1 month. For some other entities, like say, you know, like in case of heavy equipment, say BHEL type of entities, it could be year, or it could, in some cases, it could be more than 1 year also. So the operating cycle is the cycle of conversion of cash into cash. basically.
Thank you. Thank you, Dr. Avinashi. Now it is the time to wind up this webinar. I, on behalf of the Accounting Standard Board, extend a very heartfelt thanks to Dr. Avinash Chandraji and CA Dimpy ji for throwing light on the financial statement of non-corporate entities and LLPs as regards to recognition, measurement, and presentation of assets. This was the first webinar on the Do You Know series on the financial statements of non-corporate entities and LLPs. For another part, we'll be having another webinar on the recognition, measurement, and presentation of liabilities, and then the income and expenditure account. I also extend my thank to the technical support team and the staff of Shalini ma'am as from the Accounting Standard Board to give this opportunity to me and to all the members to look into the aspect of presentation of financial statements of non-corporate entities and the LLPs, for which guidance notes had already been issued by the Accounting Standard Boards, which are applicable from the 1st of April for accounting periods commencing on or after the 1st April 2024. Thank you, Dr. Avinashi. Thank you, Dimpy ji. And thank you, team ASB.
Thank you, sir. Thank you.
Thank you.
Thank you so much, sir.
Thank you.